December is the perfect timing to review your portfolio. And today, we're going to give you a step-by-step process to avoid those eternal dilemmas. Fellow investors, bonjour. This is Mike Leroux, founder of Dividend Stocks Rocks and passionate investor. You're listening to the Dividend Guy blog podcast where I and my co-host Véronique will help you invest with more conviction so you can enjoy your retirement. Dividend Gold investors, bonjour. Mike Leroux here. You're listening to the Dividend Guy podcast. I hope you are doing well. We are wrapping some Christmas gift these days. How are you doing, Vero?
I'm doing great, Mike. And you know what? My daughter just loves Christmas. So we decorated the house back in November. She
Whoa!
was just in an urge to do it that I was like, okay, I'm gonna do it for you. So yeah, I'm in the mood for a while now.
and I bet that your husband is starting to get tired of it already.
Yeah, that it's like he's the Grinch of the family, so he's not like he's not living his best life for a month. But I mean,
Yeah,
we
he has
have
to get
kids,
over it.
so
It's going to be over in a few weeks anyway, so.
so Mike, 2024 is coming to an end already, and I thought it'd be the perfect time to help investors review their portfolios for the year. And today's episode should give you listeners a canvas you can use each year.
Yeah, so I'm not a fan of daily follow-ups or weekly follow-ups. And then even sometimes investors are sending me emails say, hey, Mike, have you seen like this company? They just declared their earnings. The stock it dropped by 10%. And I'm like, I'm not aware of that. So
Mhm.
I rather do quarterly reviews, but then I always reserve a time at the end of the year for a bigger reflection and to take my biggest decisions. On the other side, when you do your yearly review, regardless if you do it in December or in June or whatever, it could be confusing. There are a lot of things to consider. There are always a lot of noise. And depending on when you look at your portfolio, there are always like big narratives coming up. So, of course, this year, a lot of people waited for the election to trade. Now
Mhm.
that the election has passed, you kind of realize that the market is the market. It goes up, it goes down. There's not a clear direction. There's not a clear answer to your questions. So maybe that waiting for a specific event is not the best timing. So what I do is I just prefer to do it at the end of the year like this because we close DSR office for 2 weeks. It's very
Mhm.
calm at home. Everybody is like sleeping in the morning. I wake up and then I can take some time to look at my portfolio.
So, Mike, you often say that we should monitor our holdings quarterly. However, you recommend acting yearly. So, why is that?
Well, the first thing is sometimes you will have a bad quarter or a very, very strong quarter in the year, and that
Mhm.
creates a lot of fluctuation. And then your portfolio could go towards one direction for 3, 4 months, and then it could be completely the opposite after that. So, for example, if you look at what happened on the stock market in 2023, we started very strong. So 22 was a bad year, and then first quarter, second quarter, the overall sentiment was a lot better. The stock started to go up, and then the third quarter between July and October, it was down big time. And then
Mhm.
it was back up, and then 2024, we all know that it's a pretty good year for all investors as well. So if you're trying to base your decision each quarter and trying to sell and buy stocks at that time, well, you're probably going to do a lot of transactions because just following the market so close, it's not a good idea. The
Mhm.
other point is you should be investing for the long run. So, and by long run, I'm thinking more than 10 years. So just 10 years, that makes like 40 quarters. So one quarter is not much. If you invest for like the next 30, 40 years, that's like hundreds of quarters. So if you're starting to like modify your portfolio quarterly, you're just in for being very busy and paying a lot of fees to your broker. So I guess they're gonna like you for sure. Another example to follow, like stock specifically every quarter. We just had a good example with Kushtar. and
Hmm.
its saga to go after 7-Eleven. So it started in August. We had more news in September. We had more news in October. We had more news in November. So, and at the time of the recording, I'm not even sure if it's going to be ending or not, because I mean, this thing is ongoing forever. But if you're trying to make a play on that trade, it makes it incredibly difficult.
Hmm.
And actually, most of it is just noise at this point. So, unless you have like a real offer that both parties agreed, or one party just walked away and then the deal is off the table for good, well, you should not even spend time to wonder about what ifs, because you're going to spend, like, again, you're going to be very, very busy, but you're not going to end up with a clear decision. And this is where you get into too much dilemmas for nothing.
Right. And Mike, the markets have been performing strongly overall this year. An investor's sector allocation can explain some of the results, but do you also compare your returns to a benchmark before starting your review?
I This is not the first step that I do. Actually, it is one of the last ones.
Mm,
First, I don't want the performance to influence my decision, especially short term. But at the same time, there is a comparison that needs to be done with a benchmark over a long period. So even 5 years, I would call that a short period. So ideally, I would go for like 7 to 10 years to go full to through a full economic cycle, because I mean, on one year you could be super lucky or bad lucky, and then that's pretty much it. I remember a few years ago when I was a financial planner, there was a year where all portfolio managers that didn't have Apple failed to beat the index, and
hmm.
everyone that had Apple in their portfolio actually matched or beat the market. So it just shows you how one decision for 12 months could have like a major impact. And again, over the past 2 3 years, if you do not have a good exposure to the S&P 500 or the Magnificent Seven, so the Google,
Right.
the Meta, the Apple, the Microsoft of this world, it's really hard to keep up with the US market. So chances are you're lagging behind. Or if you're just investing 100% of your money in Canadian stocks, of course you're not doing as good as Americans. But that's just normal. It's being explained by your allocation, not necessarily by what you're doing. The reason why I compare my performance over the long run to the market is I want to make sure that I'm actually doing a good job. You know,
Hmm.
it's there's no point for me if I destroy my portfolio and I average like 3% over the past 10 years while the market is up double digit. Well, maybe I'm not that good of an investor, or maybe my strategy doesn't work. And maybe I should go back to index investing, which at least will allow me to match the market and do not have to spend that time. So there's always that relationship between the time and the will that you want, the interest that you have in managing your portfolio. So I
Hmm.
see that partially as a hobby. So even if I would lag by 1 or 2% the market, I would probably continue doing this. But over the long run, the whole goal here to manage your portfolio is to be in control, to know what you own and why you own it, but also to have some performance to show for it.
Right.
So if I was really behind, at one point I would tweak my strategy, revise what I'm doing wrong, or trying to explain maybe it's just because I don't have Nvidia in my portfolio. That could be another type of explanation.
So at Dividend Stocks Rock, we have a pro dashboard that makes all the steps we will discuss today available at a glance. And I've said it before and I will repeat it. It's a game changer. I just love it. However, if you don't have it, you can find much of the information mentioned today in your brokerage account. So, Mike, you'll start with a sector allocation review. To do so, you will use your global view, right?
Yeah, I definitely prefer the pro dashboard over my broker, the broker, the tools that are provided by my broker. Sometimes they're like too simple. Sometimes they're not clear enough.
Hmm.
The dashboard that we have built at Dividend Stocks Rock is great because you see your allocation, you see your ratings, you see your dividend calendar, your dividend diversification. You have everything on the same page, and
Hmm.
within a few clicks, it's super easy to have that review. The other thing I like is I can combine all portfolios and have what you call the global view. So I
Right.
can add my RSP, my Lira, the TFSA, the Smith Manaver account, and so on, just to have something in a second that I know where I'm going. The first thing that I do though is usually it takes me a few minutes because this one is really easy to manage, but I don't start with the sector allocation, but rather with the asset allocation.
Right.
And I want to highlight that because yes, for me it's really fast, but for some other people that could take a little bit longer, in a
True.
sense where the asset allocation will determine the level of fluctuation and the level of performance of your portfolio. So for example, if you're like mostly invested in fixed income like bonds and GICs, well, you cannot expect to keep up with the market when the market is up double digit, which is
Mm-hmm.
normal. But at the same
Mm-hmm.
time, when the market is down by 15%, you're going to be smiling. So, reviewing your asset allocation, making sure that your volatility tolerance is aligned with the allocation you have is definitely the first thing that you should be doing. I said it was easy for me because I'm always 100% invested and always 100% in stocks. So, well, I just look at it to make sure that I did not forget some dividend and cash laying around. But
Mm-hmm.
most of the time, I'm below 1% in cash, which is totally fine because I just use those dividend payments quarterly to rebalance the portfolio whenever I hit more than $1,000 in that account. The second thing I do is I also look at my Canadian dollar exposure versus my US dollar exposure. So I want to maintain a balance roughly 50-50. I like the US market as a Canadian because it provides me with better diversification. There are tons of companies that we do not have access in Canada.
Mm-hmm.
Magnificent Seven, again, is a great example. I mean, there's no equivalent to Apple or Microsoft in Canada. So if you want to have like that kind of exposure and that to growth, you have to go on the US side. That also cover most of my international exposure because a lot of the companies that I own are doing business outside of North America. So creating that balance, and from time to time, it will be like a red flag that is being pulled up, especially right now with the strong US dollar and the US market being better than all the other markets. From time to time, I have to sell a little bit of USD, bring it back to Canada to maintain that balance.
Mm-hmm.
And then I will go and look at my sector allocation.
So, what do you aim for regarding your sector allocation?
I want to make sure that my portfolio is focused on my favorite sectors. And here, just to be clear, there are 11 sectors, many industries, or you can call them subsectors, and there are opportunities everywhere. So it doesn't matter if you are all in financials or all or in the energy sector, you will find great companies that will match your investment strategy everywhere. So
Mm-hmm.
then the key is to be comfortable with the sectors that you have in your portfolio. And the largest sectors are the most important. And also by comfortable, I mean understanding how those companies, how the sector will react to market event. So what's going to happen with utilities when interest rate goes up? Well, they tend to decline because
Mm-hmm.
income seeking investors will first sell their utilities and go back into bonds and GICs, and also because utilities in general, they're capital intensive. This means they require a lot of debts on their balance sheet. And if interest rate starts to go up, well, of course, their interest charges will follow, and therefore their profitability will reduce. So that explains why the utility market will not do well when interest rates are rising.
Mm-hmm.
So once you know that, you don't expect in 21 and 22 that your utilities are going to thrive because interest rates kept on rising very fast. It's just normal that this sector is not performing. So even if it's a large sector in your portfolio, you understand why. And you also understand it is a sign of stability for the long run. So you're going to be happy with those.
Right.
Um, I like to have a guideline in terms of percentages. So I don't want to have more than 20% in a specific sector. It's a guideline. It's not a rule. It's not a law. If I go at 25, I'm not going to sell 5% of a sector right away, but it's going to be a flag. So I'm going to say, okay, so what's going on in this sector? And then I want to be well diversified within the sector. So invested in several industries.
Mm-hmm.
So there is a big difference. For example, if you have like 40% of your portfolio in financials, and in that 40%, you have National Bank, TD Bank, Royal Bank, CIBC, BMO, JP Morgan, Goldman and Sachs, and Morgan Stanley. They're all banks. They're all banks. But you could also have a little bit higher than 20%, but having Visa, National Bank, Royal Bank, and then Brookfield, BlackRock, or some insurance companies. So then you will touch different industry.
Mm-hmm.
The reason why it's so important is because when there is a market crisis, and I'm not talking about like a drop of 10%, but I'm talking about like real market crisis, they're usually driven by a big problem in a specific industry. So,
Mm-hmm.
for example, in 2008, during the financial crisis, all financial firms, mostly banks, took the hit, and then the rest, there was a domino effect. But if you were mostly invested in banks, it was a lot harder to recover. In 2000, with the tech bubble, of course, if you had massively invested in all those dot coms, well, it took you like maybe 15 years to recover.
Mm-hmm.
While if you were well diversified across other sectors, the first months were terrible, but then your portfolio is able to recover quickly. So it's all
Right.
about mitigating that risk and not seeing your portfolio melt down and stay very low for 5, 6, 7 years going forward.
Listeners, I hope you enjoyed the episode so far, but I have to interrupt it a minute. Our goal at Dividend Stocks Rock is to help you invest with more conviction. We know that dividend income is important for you, and this is why we have gathered all you need to know about it in the Dividend Income for Life guide. Right, Mike?
Yes, I have a completely different approach when it comes down to generate dividend income, and I wanted to share my view with that. I wrote a series of DSR fundamental newsletters that were greatly appreciated by our members this year. I received tons of comments, and a lot of them were, Mike, you just came out with some very thought provocative concepts, and at this point, I really want to change my portfolio and follow this path to a better type of dividend income. So I've did a great review of those DSR fundamentals newsletters, packaged them together, wrote a few more pages of content, and built that dividend income for life.
This guide, as you said, has been highly rated by our DSR members, and we share it for free with you today. To grab your copy, hit pause on your app, visit thedividendguyblog.com/income, and enter your name and email. You'll then receive the email with your download. And also, by the way, it's always a pleasure to hear from you, so please let us know how it helped you. Again, thedividendguyblog.com/income. And then you look at your stock allocation. You will mainly look at your largest and smallest positions, right?
Yeah. So again, the goal is to have like some guidelines, but not necessarily like super heavy rules. The key point in looking at my largest stocks, my largest exposure, it's to determine the exposure to risk. So right now, for example, I have Apple that is really close to 10%, at like 9.43% of all my portfolios. So again, I'm still in the global view here. I'm not just looking by account. So I have Apple in multiple accounts. So when I add it together, it's almost 10% of all my money invested.
Mm-hmm.
Now, I don't want to debate whether or not Apple is going to have a good year in 25 or whether or not it's a great company or if there's growth perspective. I just want to protect my portfolio against myself. Of course, I've been having Apple in my portfolio for more than 10 years now. I love the stock. It has
Mm-hmm.
performed well. So, of course, I'm kind of like in love with the company a little bit. I don't want it to go over 10% of my portfolio because I expect that if I am wrong and Apple starts to not be a great investment going forward, my risk is to lose maybe 40 to 50% of the value I invested in this company.
Mm-hmm.
So then I just look at the exposure to risks. If I have 10% invested in Apple, this means that I could potentially lose 5% of all my money invested because I'm wrong on a single stock. Now it's up to you to decide if 10% is too big or too little. Some people will put that limit at 15 or 20% because they have a very high risk tolerance. Some others will say, you know what, I'm not willing to lose more than 3% of the value of my portfolio. So then your maximum exposure would be 6. But I use that as a guideline. And then it's really easy to avoid dilemmas, avoid paralysis by analysis, At the end of the year, I take literally 2 minutes. I just sort my stocks from the largest to the smallest. And automatically, I know if it's above 10% or not. If it's above
Mhm.
10%, I just sell 1 or 2% and then I move on. So it takes 2 minutes. You don't have to worry about anything else. And then you can quickly take action. I did that for Apple. I did that for Alimentation Couche-Tard and also for Microsoft throughout the years. It's a great technique. I don't have to like think too much and overthink and end up not doing anything. So that's great. And on the other side, you have like the smallest position. I usually, what I do is I will trim the big guys and then I will reinvest in the smallest positions,
Mhm.
mostly because I want all stocks in my portfolio to actively participate. If I have a company at like 0.32% in my portfolio, I mean, it could double in value. It will have zero impact on my returns and zero impact on my retirement. So I'd rather have like around 3% is my ideal position because I want to always hold between 30 to 40 stocks. So around 3% is a good average. If I have anything close to 1% at one point, I will have to take a deep dive into that company if I want to keep it or not. And then if I want to keep it, well, then this will be a great candidate to receive some of that trimming that I just did with the big guys.
You know what, Mike? I was listening to you talking about the weight of each of your stock, and like as we say, it's like rebalancing your portfolio, but it made me think about rebalancing our car. Like sometimes if we just change the tires, or we put some air in it and we don't rebalance, then at some point our car will be always on the left side and not on the right, and so
You
it's
need a
going to
good
be,
alignment for
yeah,
sure.
it's gonna be harder to drive. So it's the same thing. I mean, if you want to go straight ahead, you need to make sure that everything is balanced.
Yeah.
Um, and so I want to make this process as clear as possible for listeners. So again, you use a global view of all your portfolios, and it's also important to note that you haven't taken any action yet. We're just in the analyzing phase for now, right?
Yes, that's correct. So of course I'm close. I'm getting closer to take action because I already know
Mhm.
that I will have to sell a hold like some of my holdings if I'm above 10%, for example. But at this point, the goal is to identify potential weakness, and then it's a time to reflect. So usually I do it in like like in two segments. The first segment is really just looking at the portfolio, taking those notes, thinking, okay, so I would have to get rid of this, buy a little bit of that, and then I kind of like let it rest a little bit, like a good piece of meat. So you cook it, you want to let it rest, and then you're going to go forward. It's a good time to reflect. Again, the reason why I do it at the end of the year is just that I have more time. So, and there's no rush here. I mean, you could do that for over 2 weeks period and it's going to be fine. The
Mhm.
stock market is not going to go up by 50% or drop by 50% in the next 10 days. So you can take the time to do this. Recently, I noticed that I had a small position of a company that I really love, but I tend to forget all the time, and it's Canadian National Railway.
Mm.
So CNR, I mean, I love railroads, but a lot of others of my holdings have performed so greatly that this one is kind of like going smaller and smaller and smaller. And then at one point, I'm like, oh, okay, so probably that the next money that I have available will have to be invested in CNR to create that balance that we have talked about
Mhm.
and bring CNR a little bit back closer to that 3% guideline of a position.
So basically, for now, we did asset allocation, sector allocation, stock allocation. As the fourth step, you will proceed to a ratings review. At DSR, we rate all stocks from 1 to 5, but investors can also do it alone. What value does a rating system bring?
So, for example, we have two rating system at DSR. So we rate the stock in general. So that's called the pro rating. It goes from 1 to 5, as you mentioned, and it's an assessment of the quality of the dividend triangle and the potential growth of the company. Then
Mhm.
we have the dividend safety score, which again was scored from 1 to 5, which is an assessment of how great the company will be at increasing its dividend moving forward. So to get a guideline, if the company doesn't increase its dividend at all, it will be rated as a 2. If it matched the inflation or a little bit higher than that, it will be a 3. And then if it goes like mid single to high single digits, going to be a 4. And then fives are pretty rare, but those are like companies that has a good chance to increase double digit for like 5 to 10 years going forward.
Mm-hmm.
So of course we don't have that many, but that's pretty much to highlight that. Again, you can do that alone in your portfolio, rating your stocks from 1 to 5 or 1 to 10. The idea is just to give an appreciation and assessment of the quality of the company that you have. And it's a really good tool to compare those stocks. Then, of course, you cannot trade on ratings as any other financial metrics. It would be like saying, oh, I'm going to sell because this company over the past 12 months showed negative revenue growth.
Mm-hmm.
So, not a good year. I'm selling because of like one single metric. That doesn't make much sense, but it's a good point to raise a flag and then to go a little bit deeper, though.
So then what type of rating change is a red flag?
So, what I do when I look at my pro report in the dashboard is I will focus a little bit more on the companies that have a rating of 1, 2, and 3s. Hopefully, I don't have any ones because the ones are definitely bad. The money has been gone. So it's kind of like a little bit too late to act. So the
Mm-hmm.
only thing that is left is just to sell, but I would not necessarily do a deep dive. So the 2s and the 3s will caught my attention. Uh, it's usually a good sign that there's some weakness going around the company. So we use those rating at DSR just to highlight specific things that happen for a stock for our members so they can take a deep dive and reflect a little bit more about why the rating has changed. So, for example, I have BlackRock in my portfolio, ticker is BLK,
Mm-hmm.
and it has a dividend safety score of 3 because the past 2 years, the dividend increase was quite weak. It was below 5%. So, before that, it had an almost perfect dividend triangle, so showing constantly revenue growth, earnings growth, and dividend growth. The numbers were great as well. And then over the past 2 years, a slowdown of the dividend safety score of the dividend growth led to a downgrade from a 4 to a 3. So now I have a mental note to take a look at BlackRock for 2025 because if the company continues to offer like a 2-3% dividend increase, this is not exactly what I want in my portfolio. So I'm not saying that you should sell or I'm not saying it's a bad stock, but I'm just saying it's not perfectly aligned with what I
Mm-hmm.
want. In an ideal world, I would love to have only companies that are thriving. So companies showing mid single digit at least growth for the revenue, the earnings per share, and the dividend. When it's not happening, that raises a flag. And then I have to ask myself, okay, so for how long I'm going to keep holding that stock? And eventually I could end up with a decision like Texas Instruments, TXN,
Mm-hmm.
that will be sold in the next few days, mostly because we see a slowdown in the dividend triangle. So weaker revenues, weaker earnings per share for the past 2 years. And something very strange is happening. The stock price is relatively strong. So because right now I am in the position that I'm kind of like paying way too much for a company that is not showing great numbers, there is a discrepancy between my investment thesis and the dividend triangle. So the dividend
Mm-hmm.
triangle is relatively weak right now. The thesis is still good, but at one point, if the stock price has not moved along the way, two things could happen. It's going to catch up and then the stock price will fall, or hopefully the company will turn around and show more growth. Now I already know that I'm a little bit overexposed to the technology sector.
Mm-hmm.
Definitely there are better opportunities in there than picking a companies with weaker sales and weaker earnings. So for all those reasons, it is a pretty great timing to actually sell TXN in my portfolio, make a lot of money because I'm over 100% return on this one, but it's probably time to move on because it is not aligned with my strategy.
So basically, at this point, you have completed your quarterly reviews and taken notes. So you take time to revisit them and determine whether stocks should be sold.
Exactly. So some stuff could happen throughout the year, but you want to revisit those events. Sometimes I like to say I'm taking mental notes. So, for example, throughout the entire year, I've discussed how I've followed cash flow metrics for TELUS. So, cash flow from operation, free cash
Mm-hmm.
flow, and capital expenditure. And I explain a lot of times on this podcast and also on the YouTube channel that what I wanted to see is an improvement in the cash flow from operation and the free cash flow. I wanted to see also the free cash flow covering the dividend and hopefully capital expenditure to slow down a little bit so it will liberate a little bit more cash flow for the company. This is exactly what I saw. So I
Mm-hmm.
have no reason right now to sell TELUS, even though the stock price was not great. The stock price performance was not great in 24. So
Mm-hmm.
I'm willing to be patient because the metrics that I've decided I was following and it was important to me are actually getting better. So that's good. Another example would be Alimentation Couche-Tard. So everybody knows that I'm a fan. I've been holding this company forever. This year was a bad year in terms of performance, but also
Mm-hmm.
in terms of financial metrics. But that's fine. That happens to stocks all the time. I mean, you cannot expect a company to thrive every single day for the next 100 years. It's not going to happen. I mean, yeah, I exaggerate a little bit, but it's pretty much the same thing. I mean, you cannot expect a company to always beat records after records
Mm-hmm.
after records. So, all right, Kushtar is taking a break this year. That's fine with me. I'm willing to wait 2 to 3 years. But then what I'm going to look at is the same thing, the dividend triangle. So I will want to see improvement at one point. And I also want to hear more about what management is doing. So right now, management has a plan. They have a 5 year plan. It's well described in their investors presentation, so it's easy to follow. I can follow through every quarter to see if they are actually not only taking actions, but to see if those actions are actually doing something and being profitable for the company. So I
Mm-hmm.
am able to follow the stock. If they fell next year and the year after, well, then at one point I will have to admit that ATD is not as great as it was before, and then
Mm-hmm.
it's probably time to let go a part of it or all of it. But we're definitely not there yet. I'm just explaining the notes that I had taken this year and the time that I'm willing to wait. So I'm not going to wait for the next 5 to 10 years, but the next 2 3 years, they have plenty of time to turn things around. Anyway, there's also many things still going on with Kushtar. I'm not too worried that I will have clearer explanation and clearer direction going forward.
So, in which order will you select stocks to sell?
Um, So first things first, anything that doesn't match my investment thesis versus the dividend triangle. So
Mm-hmm.
it's really important for me to verify if any of my holdings still show the reasons why I bought it. So the narrative or the investment thesis or the story you tell yourself about how you're happy to have this company in your portfolio. But then I want to make sure that those reasons are backed by facts. I want to make sure that those reasons are backed by numbers.
Mm-hmm.
So as I explained, Texas Instrument, perfect example. Right now, the thesis is still good, but the numbers are not great and the stock price is high. So then I have all the reasons in the world to get rid of this one. Um, the second step that I will do is I will trim the my largest exposure to stocks. For example, Apple right now is at 9.45. It is really close to 10%. So if I need a little bit more money to buy something else or to rebalance my portfolio, I might sell 1% of Apple to reallocate it because
Mm-hmm.
I'm getting very close to that 10% limit. I might not do anything at this point, but that just to illustrate, if Apple was at 12%, I would automatically sell at least 3% to bring it down to 9 and then use that proceeds to buy other type of companies. Then on third position, I would revisit each sector and look to make sure that I do not have many duplicates. So companies with very similar business models, because then my exposure to specific risk would increase. So we'll see if I need to trim a little bit. Again, currently I have 23% of my portfolio invested in the technology sector and then 23% in finance. So those are like my two biggest sectors. It's almost 50% of my portfolio, but they are well invested across many industries. I already said that I would sell a little bit of Texas Instruments. So technically, I will go down that 20% for this part. And on the 23% finance, I have two asset managers, I have two banks, and I have one payment processor. So three different industries. I'm well covered there. It's not a big deal that I'm at 23%. It's not too bad. So I'm comfortable here. I will probably not do any modification in the financial sector.
Okay, Mike, you kind of already mentioned that previously in the episode, but when selling stocks during your yearly review, will you start by reallocating the proceeds to existing positions or go for new holdings? And most importantly, how do you determine where to start?
Well, it's easy to start when you have sold your position and you have cash, because then you can revisit your allocation and see what's the result of those sales,
Hmm.
and maybe you have solved some of your problems in terms of asset or sector allocation, and then it's time to see if there are any amazing companies in a sector that you're maybe like a little bit underweight that are on your buy list. So we'll review the buy list, see. I'll be like looking for new stocks, but at the same time, I don't necessarily want at all costs to buy new positions, because that
Hmm.
means I need to follow them every quarter moving forward. So it's kind of like a recurring expense of time that is required if I keep on adding great stocks. And
Hmm.
the other thing is, depending on the flavor of the moment, there's always great stories. So I mean, I've seen a lot of investors just buying more stocks and more stocks and more stocks, and then it ended up with like 50, 70, and 100, which, I mean, it's not the end of the world, but it will require you a lot of time, and several of them, they could go up or go down, and it won't affect your portfolio. Some people like it that way. I'm on the opposite side. I rather have between 30 to 40 stocks, and keep in mind, I do this full time, so
Hmm.
that kind of like changed the time that I can allocate to look at my portfolio. uh, in general, I will have a big preference to buy more of what is small in my portfolio. Like I
Hmm.
mentioned, Canadian National Railway, mostly because I've already done the hard work. I've already done the due diligence. I spent hours looking at the company. I know it.
Right.
So I'm a little bit more comfortable investing, buying more shares of CNR than going into a whole new company that I have to do the whole full due diligence, read financial statements, like write down my investment thesis, making sure that all the numbers are making sense. That's a lot of work. So if I have something that is working in my portfolio already, I can just add more of the same, keeping it simple. It's usually a good solution to keep everything simple when it's time to manage your portfolio anyway.
Right. And I think it's important to mention that we didn't consider the price of our stocks in this yearly review. As you often say, the price of a stock is not a reason to buy or to sell, correct?
Yeah, totally. I mean, it's a great source of distraction, and in my opinion, a lot of investors are making that mistake. The stock is up 20%, it's a winner, I'm going to keep it. The stock is down 20%, it's a loser, I'm going to sell it, it's a bad investment.
Hmm.
You need to add context and you need to understand. Great example again with Texas Instrument. It's up about 20% this year, so no reason to sell it. Since I bought it in 2017, it brought me more than 100% total return.
Hmm.
Another reason to keep it. Well, what does it mean? Every single time that I have a winner in my portfolio, I'm going to keep it forever until it's not right to hold it, and then I'm going to lose money on it. And every time I will have a loser, I will hold it again forever until it recovers. I cannot base my decision on stock price. I rather base my decision on what I explained before, the investment thesis that must be matching numbers. Earlier this year, I had to sell Magna International because it was long time due, actually, because it was just a company that kept on reporting shaky earnings. I would call it that way. So one good quarter, one bad quarter, sometimes improvement in margins, sometimes they were going down. And at one point, my narrative around Magna was still very strong. I still love the company, but I had to come to like the obvious conclusion that I was wrong, or it's not strong enough to support numbers quarter over quarter. So I just
Mhm.
sold it and reallocated to a company that was like smaller in my portfolio at that time. So sometimes in the middle of the year, I would do that kind of trade, but I'm trying to keep all of those at the end of the year. It was just too much. I mean, for Magna International, I was really close to sell it last year during my yearly review, but then numbers started to improve again. So I was like, oh, I can wait. So things are going better. So and then it fall again. So I'm like, no, that's too much. Too many times that the quarterly earnings are not aligned with my thesis. I had to let it go. But regardless, I made money selling Magna International, not much, but I still made money. But I'm going to have the same reflection about Texas Instrument, where I made a lot of money. But again, that was not the point. Yes, the stock price is a lot better, but it's probably time for me to let it go and making sure that I invest with companies that are more aligned with my style, with what I believe in. Because when I do this, I also increase my level of conviction in my portfolio.
Mhm.
And if there's a market crash and my portfolio value decline, well, I'll be a lot more comfortable with another stock than Texas Instrument, because the first reflex I would have if I see my portfolio going down is looking at each of my stocks, and then I would realize, oh my God, okay, so Texas Instrument stock price is down, but revenue has been falling for the past 2 years. Earnings per share have been falling for the past 2 years. Well, maybe it was time to sell it before waiting to take a decision just based on stock price.
Mhm. Mike, let's pretend I'm doing my yearly review and don't feel confident about my portfolio. Like this could happen. Do you think it's more a matter of my confidence towards my stocks, my strategy, my asset allocation, all of the above? I mean, how do I make a difference?
Do you have anything to share with us, Vero, before I
No,
continue?
I'm just trying to put myself into someone else's shoes.
Asking for a friend. Asking
Yeah.
for a friend. Well, I would say it's really important that you take a time to identify what bugs you about your portfolio, what makes you concerned. Is it the dividend safety of your portfolio? Is it your allocation? Maybe it's your performance. It could be a lot of things, as you mentioned, but like putting the finger on what really is important to you and why you have not that level of trust towards your portfolio that it's going to actually help you achieve
Hmm.
your financial goals is really, really important. That's why at the beginning of the show, we discuss asset allocation. It's also a good point where if your portfolio is down and you couldn't sleep throughout the year and you didn't feel good about it, maybe it just tells you that your asset allocation is wrong. Maybe you're not, maybe things have changed for you and your perception of the market or your financial situation has changed, and maybe you don't want to go through another 10-15% drop in your portfolio,
Hmm.
and that's totally fine. The key is always to find a strategy that helps you sleep well at night. So we don't care about total returns, we care about reaching financial goals and sleeping well, because if you don't do that, what's the point? uh,
Hmm.
so then I would say the remedy to hesitation or to be concerned is knowledge. When you are fully aware of what you own and why you own it, you're going to feel good about it. And a good way to improve that is with a straightforward strategy, keeping
Hmm.
things simple, keeping small rules. I mean, today we have discussed this like at length, but like to summarize it quickly, I look at my asset allocation, want to make sure that my asset allocation reflects what I want to do. So in my case, 100% invested at all time. I want to maintain a balance between Canadian and US stocks. Then for the sectors, I want to also be invested in sectors that I'm comfortable with, that I understand, and I don't want to be overexposed more than 20% on a sector. If it happens, I will review the industries, making sure that I'm well diversified and I am not at risk to get hit by a single market event.
Hmm.
Next step is I look at my stocks allocation, thinking the same way. What if I'm wrong with my biggest guys? Well, am I comfortable losing half of the money I invested in my largest position? If the answer is yes, I keep on going. If the answer is no, it's time for me to start trimming. I don't look at the company at this point, I just look at the exposure to risk. Then comes the stock analysis. So throughout the year, every quarter. I've reviewed the quarterly earnings. I've took make mental notes. I will use ratings to guide the time and my focus on specific stocks. Of course, for a company that is business as usual, that reported double-digit earnings growth and everything is great and the ratings are strong, there's no point for me to spend a lot of time on this one. It's all great. I take like a 5 minutes to make sure that it's still all great, and then I move on to those that needs more of my attention. Once I've done this, I already have a quick list of stocks that I might have to sell. Some years, it's a good year. I don't have to do anything, and that's great. Because the goal here is not to do like 10 transactions at the end of the year either. And then I will start by selling companies that do not match my investment thesis, or the investment thesis doesn't match the financial information. So the metrics that I'm tracking. I'm going to trim the big positions, and then I'm going to reallocate that money either into smaller companies that are great in my portfolio and I just want to bring it back to the same level and the others, or I will look at some great companies in a sector that I'm not overweight already, so I can rebalance my portfolio, improve the diversification, and move on.
Mhm. Well, we recently held a webinar about dividend income for life. Listeners, you can watch the replay now for free, like it's instant replay, at thedividendguyblog.com/webinar. We also shared the Dividend Income for Life guide, which could help investors better understand and feel comfortable with a dividend growth investing strategy, even at retirement. Right, Mike?
Yeah, so the strategy that is being laid out in that guide is actually the strategy that I use for my personal portfolio and also at Dividend Stocks Rock. It's a bit unconventional in a sense that we do not focus on high yield, we focus on high quality companies instead. And we made the argument there that high yielding stocks are actually dangerous for retirees in
Mhm.
most cases. We explained why, we explained the results. And after looking at all of this, you might want to revisit your portfolio to make sure that the dividend is safe and also that your portfolio is well diversified so it can create that paycheck you're looking for. And as a bonus, in the guide, we also explain you how to create that paycheck, even if the yield seems a bit low for you. And you may be thinking, well, I can't retire on $20,000 of dividend. Well, there are alternatives to that, and there are ways to protect your portfolio against market drawdown when you are withdrawing money for your retirement.
Mhm. So you can download the dividend income for life guide now at thedividendguyblog.com/income. So, Mike, thank you a lot for helping us review our portfolio for the year and start 2025 more confidently. Listeners, remember to watch the webinar replay at thedividendguyblog.com/webinar or download the guide at thedividendguyblog.com/income. For the show notes and related content, visit thedividendguyblog.com/205. If you like what we do, please hit pause and subscribe to the show now. You may as well leave us a 5-star rating while you're there. And until next week, stay invested.
Hey, fellow investors, it's Mike here. I hope that you have enjoyed this episode. Please note that the Dividend Guy Blog podcast is at no time issuing buy or sell recommendation. Please do your own due diligence as this podcast is recorded for information and hopefully fun purposes only. Make your research, make sure you do your stuff. We're not responsible for your losses or your profit after listening to this episode. And until next one, stay invested.